In this video, we're going to be going over discount terms, and then we're going to do some purchases and some discounts associated with those purchases. So, if you're purchasing something from a company, sometimes you can negotiate some terms, some special terms if you pay in cash up front or if you pay within a certain time period. Here we've got 1/10 net or N/30. And what this stands for is you can get a 1% discount if you pay within 10 days of the sale. But the whole thing is due, the net amount, the whole amount is due within 30 days, okay? If you saw something like this, 2/5 N/60, then this would mean you get a 2% discount if you pay within 5 days, but the whole thing is due, the net amount is due in 60 days. Or you could see something like this. N/10 EOM, meaning that the whole thing is due 10 days after the end of month, okay? This isn't super popular, but you will see that out there occasionally. There's no discount associated with this, it's just telling you that you have to pay within 10 days after the end of the month. Okay, let's move on to some examples now. Let's say that you're purchasing some inventory, and let's say that we purchased it on September 3rd, $1,500 worth of inventory. So we received inventory, so we're going to debit inventory 1,500, and then we're going to credit, I'm going to abbreviate A/P, which is accounts payable. Not a lot of room here, but there we go, 1,500. So we debited inventory, we increased our inventory, which is an asset, and then we've increased our accounts payable, which is a liability, meaning we owe the 1,500. Now, let's say the terms for this were 2/10 net/30. So it says that if we pay within 10 days, we get a 10% discount. If we pay within 10 days, we get a 2% discount. So let's say 10 days later, we make our payment. So we're gonna get a 2% discount. 2% of 1,500 is $30, okay? Well, first of all, we have to eliminate our accounts payable. Now notice, we're going to eliminate the full accounts payable of 1,500. Now we have to write a check, pay them. So we're going to credit cash, which is our asset, to reduce our asset. It's going to be for $1,470 because we're not going to pay the full amount because we're paying within the 10 days, so we get a 2% discount. So we're actually only going to pay $1,470. Now, you can see that our journal entry is not in balance, and we need to make it balanced, so we're going to have to credit another $30. I think this is going to make perfect sense to you. Inventory, we originally recorded inventory at $1,500. Did we pay $1,500 for that? We didn't. We only paid $1,470. So we have to credit this $30 to bring it down to $1,470. So we're going to credit inventory. Okay, so let's just take a quick look at this. Our inventory T account. Okay, we originally credited it for $1,500, debited it for $1,500. Now we're crediting it $30. So our overall balance for this purchase of inventory is $1,470, which agrees with what we actually paid for it. Okay? So in this video, once again, we went over the terms, make sure you're familiar with these terms, and then these type of entries. You need to pay special attention to the discount period, and if you are paying within the discount period, then this would be the journal entry. If you paid, let's say on September 15th, then what your entry would have been is accounts payable 1,500 and cash 1,500. If you didn't pay within the 10 days, you have to pay the full amount. Okay? Good luck with the next videos. We're going to go over transportation costs, allowances, returns, and we're going to look at sales too.